Give me an E, give me a T, give me an F. What does it stand for? ETF, or Exchange Traded Fund. So what is an ETF? An ETF involves a basket of securities and can have thousands of underlying assets. A unique aspect of ETFs is that they trade on an exchange, such as the New York Stock Exchange or the NASDAQ. Because ETFs are listed on an exchange, their prices fluctuate throughout the trading day and trade under ticker symbols just like individual stocks. However, when investors purchase shares of an ETF, they get a little piece of all the assets in the fund, which is similar to how a mutual fund works. Although they share some similarities, ETFs and mutual funds have a lot of differences, but more on that later. So let's take a look at some different types of ETFs. There are index ETFs, which are a type of index fund and as such track an index, like the S&P 500. Sector ETFs, which track market sectors like healthcare and energy, as well as industry ETFs, which follow subsections within those sectors like biotech or renewable energy. There are also bond ETFs, which can include government, corporate, and municipal bonds. Commodity ETFs invest in commodities such as gold, crude oil, and natural gas. And also currency ETFs, which invest in the US dollar or foreign currencies such as the pound or the yen. If you're looking to diversify your portfolio or holdings, ETFs can be a great tool. Perhaps you don't have any consumer discretionary exposure in your portfolio. The consumer discretionary sector is comprised of companies that sell non-essential goods and services. Now you could invest in a sector ETF or even go more specific within that sector with a retail ETF to gain that exposure. Maybe saving the planet is an important cause to you. There are clean energy ETFs you could invest in. There are a wide range of options. Now let's compare mutual funds and ETFs. Mutual funds were first introduced in 1924, and ETFs came on the scene in 1993. The two are similar in that they both pool assets, which are divided into shares and sold to investors. Other than that, they are fairly different. ETFs are bought on an exchange, whereas mutual funds can be bought through a brokerage firm or the fund itself, such as Fidelity or Vanguard. As a result, the two trade in different ways. ETFs can be bought and sold throughout the day, just like a stock. They are also transparent because you can see all the holdings in an ETF whenever you want. In contrast, mutual funds only trade at the market close, locking investors in at a particular price. In addition, mutual funds don't release their holdings until month end or quarter end. It varies. Now, unlike mutual funds, which are often an active investment, ETFs are a passive investment because ETFs don't have active managers. They typically have lower fees than mutual funds. Although many stock trades are commission-free now, ETFs may have fees when buying or selling. Clearly, investing involves some shopping and some research in order to determine what the right choice is for you. Whether you choose ETFs or mutual funds, remember to do your research first. Check how much the fees are and compare the fund's holdings to your portfolio to make sure you're diversified.